What's going on, Eagle investors? This is Samuel here to talk about the extreme energy crisis going on in the globe. Now, first, energy prices are skyrocketing across the globe, and a cold winter could mean this extreme rally continues. How did this start? What energy is moving? And how can you trade off of this situation? Now, the ongoing energy crisis has complex origins. A resurging demand as economies reopen, weather conditions with a lack of wind, reducing wind turbine generated power. This has to be compensated with by natural gas. And this was also over a summer with high heat, meaning air conditioning was also in high effect. Decarbonization efforts with China reducing coal production, OPEC policy, this week's decision not to increase oil production, and EU energy policy to buy natural gas for only short-term contracts. And then also related, geopolitical considerations, potential geopolitical considerations, with Russia's willingness to potentially increase natural gas deliveries to Europe. This is particularly concerning in Europe with this whole energy demand crisis, as you'll see natural gas prices have gone from $2 to 55 overseas, while in the United States, they've been a lot more stable, but we'll see later, they've still spiked up quite a bit. Now, WTI crude, that's United States crude, West Texas, has breached $80 a barrel, with Brent crude, which is more on the international exchange, is even higher than that. Natural gas has spiked, as I mentioned, in Europe, and coal has even jumped in China as they're really fighting to keep their factories open. So they've even gone back on their word on decarbonization policies and the goal of the future. There's also a 7-year high recently, earlier this week, of $3.27 a gallon for gas in America. Now let's look at a few of these different energy underlyings and the price action over the past year. Now this is WTI oil futures. We see, they were in the low 50s at the start of the year, and besides some drawbacks, has basically just rallied up past 80. Now in particular, July there was a sell-off and there was a lot of volatility with the yield market and how that was going, along with how equities were following. But since the end of August, it's just been straight from 61 to around the 80 handle. Now looking at natural gas, this isn't the European contracts that spiked up to 55, but we see earlier in this year, they were pretty stable in the $2 range, and they've climbed and climbed and basically gone parabolic up to, over the $6.5 level. Recently, they've cooled off a little bit, but they're still at extreme price levels, and the volatility in these underlyings is also quite extreme. So that's a consideration when looking at any potential plays and options that you could trade based off of, as high implied volatility means you're going to pay a lot for that contract's premium, and that's not a favorable outcome. Now looking at XOP, what's XOP? XOP is the S&P Oil and Gas Exploration and Production ETF. So this is basically a collection of all these different companies that deal with the exploration and production of oil and gas. It typically has a correlation with crude oil of 0.6 or 0.7, closer to 0.6 usually. And so they follow in line, but there are more considerations as there's individual company risk, there's the earnings and things of that nature that aren't just tied to the underlying commodity. But what we see here is also the same rally, and ever since the end of August, it's just basically gone straight up. So what we're seeing here is we finally saw XOP over $100 back to 106 level, and this is expected to continue if oil doesn't in fact continue pushing to the 85 level, 90 level. Now, target upside management plan, it really depends on what strategy or trade you end up deciding on, as well as the underlying. But setting up an asymmetrical risk reward position would be critical in a market of this nature, because you basically want to have target upside of 200, 300, 400% potential if these energy prices keep rising, but you want to manage and mitigate your potential loss. So like the worst thing that you could do if you think these energy prices might squeeze but might burst is just going long futures, as the downside is just as heavy as the upside and the leverage is there on both ends. So we'll go into an example trade on the next slide. But management plan, you will have to watch the situation in Europe and how that's playing out, weather forecasts, as well as looking at the price action if there's a potential reversal. So I also cautioned against just going long call options, because the implied volatility on these underlyings has the fact that it could continue to rally, basically priced in a sense. So if you're paying a heavy premium on these options, it makes the likelihood that they profit as you wish less likely. So here's an example trade that I posted on Eagle Investors platform. And what this is, it's a debit call spread, so it minimizes the implied volatility impact. And it's on crude, WTI crude, which also doesn't have a crazy IV as it's been expanding. But what this basically does is it's going out to December 15th, so about to the end of the quarter, and saying if WTI crude is over $87, currently it's at 79 in this month that I'm trading. If it's over 87, basically I have a 300% return. And the lowest, the most I can lose is 100%. Now, if it's above 85, it's somewhere in between that minus 100% and plus 300%, as you can see on this price and loss payoff diagram. Now, if you want to trade into the natural gas futures or the liquid option chain on that end, I'd caution on the implied volatility, as it's extremely high. So you might want to look at more favorable spreads or even credit strategies that capitalize on your viewpoint. Even neutral strategies where you're not necessarily bullish or bearish on natural gas can play out because of the implied volatility rank being so high. So in summary, the current energy crisis going on right now is getting worse before it gets better. Now, there's many factors that need to be considered on a geopolitical basis, whether, in Europe, China, United States, policy. There's many things going on, but paying attention to the different underlyings and the opportunities, both in the futures, the options, and the capital markets, can be critical if you want to take advantage of or potentially trade on these items that are going on currently in the world. Now, as energy prices continue to squeeze, action can be taken if properly set up and managed. Now, thank you for watching. I hope you enjoyed this video. Make sure to like and subscribe and join the Discord trading community in the description below.